Hi everyone, let's go over my micro and local bullish and bearish Elliott Wave scenarios on Bitcoin, starting with the micro bearish scenario where we're looking for an unfinished WXY to the downside, where in this wave Y we are then looking for a zigzag to the downside in a 535. And as you can see, price has also passed the 0.618 fib time taken from the high to the low of W to the high of X, which is usually a minimum requirement for the low of a wave Y. This low over here was made before the 0.618, which is quite rare, and therefore the probabilities of this scenario are higher than continuation to the upside at the moment. However, in this particular scenario, if we are looking for a 535, we want to count three wave structures to the upside more locally. This should be a corrective structure for then another impulsive move towards the downside. So if we then zoom in to the local time frames, I basically have a bullish and I have a more bearish scenario of the price action over here. Let's start with the local bullish scenario where we expect a move to the upside to reach the upper target box first, before then a move to the downside to reach the lower support area over here. As mentioned this morning, we had bearish CVD divergences, a proper probability for price to move to the double bottom, as that is always a magnet for price as mentioned. And now price over here took the double bottom, which is area of interest number 1. If the double bottom over here doesn't hold, and we will look into this structure over here in a second, the next area of interest is this support area at 26.1k. Now, if we find proof of support, which for you could be then a market structure change, bullish CVD divergences over here, RSI, stochastic, whatever it is that you are using, eventually you'd then be looking in this scenario for a move to the upside for then a wave Y. W over here a zigzag, any correction in X, and then Y to the upside, where an area of resistance, very interesting indeed, is between 26.5k and 26.6k. Now, based on the information shared this morning, it would lead you to this idea over here. Move to the downside, potentially looking for the double bottom over here or the blue box. If there is proof of support, whatever that is for you in your plan, your strategy with your entry requirements, you can be looking for then a move to the upside before then continuation to the downside to look for that bigger support area that we have over here between 25.7, 25.9. However, of course, the alternative in this scenario, which is then also the more bearish scenario, is that the high of B is already in then a three-wave ABC to the downside. In this scenario, we're then looking for the end of B, looking for impulsive structures to the downside, which means we're going to be continuing to the downside, which is this alternative structure over here. Now that means that C has to start impulsively. So over here we want to count 5 waves in A, then we have a 3-wave WXY in B, looking for C to the downside, where this is then a wave 1, expanding flat in 2, now working on eventually a bigger 3 to the downside. But what is interesting here is the structure of wave W, because from the low to the upside we can count a nice ABC for then a zigzag in W, then you have an X here, but then another 3-wave structure in a zigzag in wave Y. And usually, by far most commonly, wave Y hits at least the 0.618 trend-based fib extension taken from the low to the high of W to the low of X. And as you can see, this high over here did not come close to the 0.618. So it didn't really hit the usual minimum target for a wave Y to end a potential wave B, which is quite interesting, lowering the probabilities that the high of B is already in, which increases the probabilities of this scenario over here, where we are still looking for another bounce towards the upside. In the end, it's all about probabilities, but of course this is not really what you want to see. But in the more bearish scenario, we're then looking for impulsive structures to the downside, where you want to eventually, of course, see some bigger candles moving to the downside instead of the ranging that we see over here, right? This is not really what you're looking for. Eventually, you want the wave 3 to the downside on volume, as that is usually the strongest wave. Now, if we look then at the more bullish scenario on the micro, so we zoom out again over here, then the low of Y is already in with these pivots over here on top of the 0.618 fib taken from the high to the low of W to the high of wave X. So then this has to be counted as a double zigzag, which is very difficult to do, but in this scenario it has to be for this to be the low and then continuation to the upside. Now you can see this low has been made before the 0.618 fib time, as mentioned earlier, lowering the probabilities, this is the low, increasing the probabilities for at least another local low to be made. And also, if this is the low of wave Y, then on the lower time frames, we want to count impulsive structures to the upside, where this is then a 1, 2, 3, 4, 5. However, this wave 4 retraced to the golden pocket taken from the low of 2 to the high of 3, which is not what you want to see and lowers the probabilities of this being a wave 4, lowering the probabilities that this over here is an impulse towards the upside. Now another idea, and also by the way, if this is wave 5, it's very much a 3-wave structure. So another idea is that we then have a 1, 2, 3, 4, 5 as mentioned this morning, but then 3 is the shortest wave compared to wave 1. This is then 3 and this is your 5. 3 is the shortest wave, which is not allowed in a impulsive structure, which again lowers then the probabilities of the micro bullish scenario. So if you then look at the CVD divergences locally, we had these bearish CVD divergences over here, which have now played out as this low over here got taken very nicely indeed. So now currently there's not really any CVD divergences. However, after this swing failure pattern over here, we did see some very, very small bearish CVD divergences. So I'm now on the 1-minute chart. And if we look on the 1-minute chart, you can see this was the swing failure pattern low, price moving up, all nice, all good. But then during the retracement, what you don't really like to see is bearish CVD divergences. And you can immediately see here, lower high on price, higher high on the CVD divergence, which is a bearish CVD divergence. There's absorption of market longs going on, and then price keeps pushing towards the downside. Some more bearish CVD divergences here as well. Lower high on price, higher high on blue, so more bearish CVD divergences. And now after the second time this low got taken, we have to wait and see what happens more locally. We can see on yellow, this is an extreme move, not sure about that one, but potentially some bullish CVD divergences, but on blue, some bearish CVD divergences. So now we have a bit of a mix, and we will see, and of course patiently wait for price to show us then what it wants to do. So if you then look at the probabilities of the different scenarios, then on the micro we are looking for another low based on probabilities of Elliott Wave theory, of course, where this is currently based on the rules of Elliott waves, the highest probability scenario, where we are still looking for another move to the downside over here for eventually then a bounce back towards the upside. And on the more local time frame, so if we zoom in, then currently the higher probability scenario is that we still find another high, mainly because of that wave Y over here not hitting the 0.618 in this 3-wave structure. So that is something to take into account. It's all about proof of support though, because if we are looking for the low of a wave X, potentially around this target box here, we want to see proof of support, whatever that is for you. I have my own planned strategy and entry requirements that I trade from, and I need to tick all my boxes before I enter a trade. And I recommend you to either have one or develop a trading strategy with entry requirements where you look for, in this case, proof of support, whatever that is for you, for then a move towards the upside. So it's interesting to see what's going to happen here. Both of the scenarios are probable, but I think based on Elliott Wave theory and the rules, this is currently a higher probability scenario leading to this structure over here. I hope this video was helpful or valuable to you. Please check out the most recent educational video I've made about the best trading indicator you can use in my opinion, which is the CVD. And for now, thanks for watching and subscribing, and I'd like to see you at the next one. Bye bye.